So one company that's been getting a lot of attention lately is Palantir Technologies. They recently reported their Q2 earnings and proved to investors that they are the most dominant pure play AI software company on the stock market right now, and that all these recession fears that are hurting so many other companies basically don't apply to them. They reported 27% revenue growth year over year. Net income continues to grow rapidly, reaching 134 million for the quarter, which is up from 28 million a year ago, and their operating margin expanded from just 2% last year to 15.5% in Q2. They also reported some very promising customer metrics. Now, these aren't specifically GAAP metrics, but they are generally good indicators for how much revenue they have secured in the pipeline and also how fast commercial adoption is picking up. And this was a key point of the bear thesis in Palantir for a long time, that they're overly reliant on government revenue, which is very hard to predict because government spending habits aren't really driven by any sort of free market forces. It more so depends on who's in office and how they plan on allocating their budget. And what they reported was 152% year over year growth in US commercial total contract value, with 83% growth in customer count and 98% growth in deals closed. And they did this while also reporting 23% growth in the government revenue side, and even announcing a new 5-year deal with the US Department of Defense worth $480 million. So things are going very well for Palantir, and as a result, investors have become increasingly optimistic about this company, to the point where it's currently trading at a price to sales ratio of about 29 times and a price to earnings ratio of about 177. And this price to sales ratio actually makes them the third most expensive tech company in the US stock market right now. So in this video, I want to take a sober look into Palantir and see if it's gotten to a point where maybe it's become a little bit overvalued, or if the valuation still actually makes sense right now. And I think whether or not you are invested in Palantir directly, this video will still be useful for you because it shows an example of how you can go about evaluating a company that is very early in its life, that seems to have a lot of growth potential ahead, but investors don't know exactly how much yet, and how you can assess that type of company. So without further ado, let's just dive right in. So the first thing I want to cover is the types of products that Palantir offers, and this is critical information to understand to know who their actual customers would be, and by extension, how big their addressable market is. Now, the thing you have to understand about Palantir is that no one really knows what this company actually does. At least from the general public's perspective, most of what they do involves very sensitive data belonging to corporations and governments. So Palantir is a bit of a black box in that sense. We do know that they have a few different products that help companies and governments perform more advanced analytics over their data, using things like AI and machine learning to draw insights from data that they already have access to and they're already kind of looking at. And their customers are large entities like governments and big corporations. But that is about all we know about them right now. Now, in terms of their products, they have Gotham, which was their original flagship product, which is primarily built for government use. And what this product specializes in is merging different types of data into one view that can be used for analysis. There's also Palantir Foundry, which is for commercial customers and specializes in ingesting large amounts of data from many different sources, and even allows users, if the user isn't a data expert or a data scientist, it allows them to build applications on top of that data and also create things like dashboards and reports that they need for business purposes. And what's interesting about this product is that it can be used by many different industries. Palantir currently has customers using this product in industries like manufacturing, healthcare, financial services, just to name a few. All of those industries are currently using Foundry. And then there is Palantir Apollo. This is probably the smallest product and is more so designed for deploying software updates across the Gotham and Foundry products. And then, in my opinion, the most interesting one, which is one they recently introduced, is AIP, or Artificial Intelligence Platform. This was introduced in early 2023 with the goal of helping companies use AI for more practical purposes, such as automating tasks, making predictions, that kind of thing. For example, AIP could be used for fraud detection at a bank. It could detect when a machine in a factory floor is about to fail, and any sort of business problem that could be solved using AI is what AIP does. Now, what's interesting to see is that ever since AI became Wall Street's favorite buzzword back in early 2023 and companies started investing massively into this, Palantir has seen very strong revenue growth and has become increasingly profitable each quarter. And you may be wondering what's the significance of that total contract value number from earlier versus their actual revenue that they're reporting. So, Palantir can sign a contract with a customer and even receive money under that contract with the customer, but until they actually fulfill their obligations to deliver the products and services to them, they cannot recognize revenue on their income statement. So TCV just tells you how much future revenue is in the pipeline as of today, some of which could not be earned until 4 or 5 years into the future. So, really, what I would use this metric is as an indication that commercial customers are actually finding value in their products and adoption is increasing. TCV should always be growing at a faster rate than revenue should be growing at, because that implies that Palantir is not only retaining existing customers, but also acquiring new ones. Now, the main issue that most investors have with Palantir right now is their sky high valuation. Currently, they're trading at about a 29 price to sales ratio. They have a market cap of 72 billion with about 2.5 billion worth of revenue over the past 12 months. But the reason it's so high is because no one actually knows how big the market for this stuff is going to end up being. If you try and figure out how big the market is for enterprise AI software, a very general description I know, but humor me for a second, you get estimates ranging from $100 billion per year by the year 2030, all the way up to $400 billion per year in total addressable market. And you also have Bloomberg publishing an article that says generative AI could be a $1.3 trillion market in 10 years' time. Now, a market of this size, however big it ends up being, will obviously have a lot of competition. And just because Palantir is early in this market doesn't necessarily mean that they will be the big winners of this market over the long term. There's been many examples in history of companies that were early who didn't end up being the big winners. You have the so-called cloud hyperscalers who are all developing their own AI offerings and already have established relationships with many of the world's largest companies. You also have C3 AI, another pure play AI company that is doing something similar. Snowflake also recently introduced their own AI capabilities, and those are just a few examples of what exists right now. So Palantir's suite of products could literally end up being anything from a world-changing class of applications that companies need to use in order to stay competitive, or just a more niche set of products that maybe some governments and maybe some large corporations use, but nothing that becomes too significant. And other larger companies dominate the AI space more and take more of that future market share away from Palantir. And this is why I think so many retail investors are very interested in this company, because objectively, it's a very interesting company. And it's also hard to refute some of the reasons why people say Palantir is a good long term investment. Reasons like they're at the forefront of this AI revolution, and the market potential for their products is massive. All of those are true. So, as a result of this, you start to see the overall finance media feeding into this narrative and saying things like this stock is a future millionaire maker or this stock has 10x potential. So, now I want to put those claims into perspective, because narratives like that I think are extremely misleading. So, using Tickernomics, I generated a list of all US based tech stocks that at least 10x'd over the past 10 years. So, basically, companies that existed 10 years ago, where if you would have invested in them, you would have made at least 10x your initial investment over the past 10 years. And that includes dividends if the company did pay dividends. And I also included stats like the price to sales ratio 10 years ago and the rule of 40 10 years ago, because that's another metric that people like to point out when they talk about Palantir. So as we can see, companies like Apple, Microsoft, Nvidia, AMD are all on this list. And if we look at their price to sales ratios 10 years ago, generally they're quite low, usually about a 3 or a 4 price to sales ratio, and even lower in some other cases. And as we can see, these are all companies with a rule of 40 score either above or close to that 40 mark. And no company on this list had a PS ratio that was greater than 20. The one outlier is ServiceNow, who had a 15x PS ratio 10 years ago, which is still quite a bit below where Palantir currently sits at today. That's basically half of Palantir's current ratio, which is about 29x. So this does prove that it's very hard to see stellar returns on a stock when they're already valued so highly. Now, let's say we don't necessarily want to 10x on Palantir. We just want to earn decent, above average, market beating returns on Palantir as a long-term investment. So I also checked to see how well US technology stocks that have a price to sales ratio of at least 20x tended to perform over the long term. So basically, as of 10 years ago, what were all the US technology stocks that had a price to sales ratio of at least 20, and then how did their returns end up being over the long term? Because this is what Palantir is right now. So Tickernomics gave me about 30 such companies, and the results are quite depressing. Basically, you would have lost money on all but four of those companies, and the only company you would have gotten somewhat decent returns on was Palo Alto Networks, which previously had a 31 price to sales ratio. Now, I say all of this not trying to convince you that Palantir is definitively going to be a bad investment. It could still be a great investment despite all of this data. But what this data does show you is that the odds aren't exactly in your favor. Now, my channel, Investing Sucks, is a value investing channel at heart. And to me, what value investing means is not just investing in low PE companies or traditionally cheap companies. It means understanding the true intrinsic value of businesses and investing when your estimate of intrinsic value is above what the price of the company is on the stock market. So Palantir could very well meet that criteria as well. Just because it is an expensive looking company doesn't necessarily mean that it's uninvestable. But another key lesson in value investing is to only invest in companies when you can, with a high degree of confidence, project what their next 5 years is going to look like. And with Palantir, that is very difficult to do. For starters, I don't think we can value Palantir like other large SaaS businesses because, well, they're not a SaaS business. SaaS businesses are things like CRMs or ERP systems where it's just one blanket solution, or software in this case, for all customers with a fairly low touch and short duration sales cycle, and there's minimal customization needed from customer to customer. And Palantir is just not this type of company. Their products are highly customized to the client's specific needs. The sales cycles are high touch and very long processes. And this matters because the reason why SaaS businesses are valued at such high multiples is because they have these attractive qualities that make them high quality businesses that are very profitable. So what I want to do now is a 5-year valuation for Palantir. And to do this, I think there's four key things that we have to understand about them: the revenue growth rate, the operating margin or just profitability in general, the terminal value multiple, and the future rate of dilution that they're going to see from share-based compensation, which for Palantir is very significant. So we'll start with revenue. For 2024, Palantir has guided for $2.75 billion in revenue. So let's assume they hit this target and then they continue hitting 25% annual revenue growth in the years after, which means they'll have about 8.3 billion in revenue in 5 years' time. Now, for operating margin, let's look at how operating expenses have trended over the past few years. So we see a pretty inconsistent pattern overall, especially with research and development expenses, but recently these have started to level off a bit, but are still generally increasing each year. Now, since these expenses are mainly employee-related expenses, these will increase if Palantir's customer base increases, which will happen if we are also assuming that they're going to grow their revenue, because employees are the ones who actually work with the customers to provide the products and services and customize them for the particular client's needs. So for this, I'm going to assume 15% annual growth in operating expenses to account for those new employees that is needed to support this 25% annual revenue growth, which is a realistic assumption because management has said that their long-term goal is to consistently keep cost growth below revenue growth. So under these assumptions, Palantir could realistically hit 35% operating margin by the end of this year and reach the 50% plus range in 4 to 5 years' time. Now, for the share-based compensation, we can see that this has actually trended down a bit over time, mainly because the stock grants that they were offering just after their IPO were very significant. But in recent quarters, we can see after having trended down, it's starting to trend up again. And this is probably because they're having to hire new employees to support the recent growth that the business has seen. So I have share-based compensation also growing at 15% per year going forward, so similar to the operating expenses. And this is a non-cash expense, so it actually gets added back when calculating the free cash flow number, which is what we're ultimately doing when we're trying to value this company. But the way shareholders actually pay for this is through dilution, right? Shares continue to get issued, which means you own less and less of the business if they keep doing this. And this is really the cost of doing business for Palantir. This is what they have to give up to attract and retain employees. So, how this looks in the actual valuation is we add back all the share based compensation expense because it's a non cash expense. But then we use fully diluted shares to determine the per share price for Palantir, which is about an additional 200 million shares worth of dilution. So, quite a lot. And then with the terminal multiple, I'll use the enterprise value to EBITDA multiple and look at some software companies to get an idea of what is a reasonable multiple to use for the future. So the last year, which is 2029 in this 5 year projection. So companies like Microsoft and Adobe, although these are different companies to Palantir, it is useful to see what other highly profitable companies with similar rates of growth are trading at. And we can see they usually have about 20 to 40x multiples in this case, so a median of about 30. So for this, I'll use a 30x terminal value multiple. So what does the end result look like? Well, under these rather aggressive assumptions, Palantir still looks overvalued. The intrinsic value is about $24 per share, while the current share price is over $30 per share. And for those wondering, this does assume a 15% discount rate. Now, if you'd like to access this full Excel file I'm showing on screen here, feel free to join my Discord server where I've shared the full file. Link is in the description. Now, for a quick experiment, let's assume Palantir can get a 30% annual revenue growth rate over the next 5 years. So even more aggressive than what we're assuming right now. Let's see how the intrinsic value changes if we adjust that. So here we get an intrinsic value of about $30 per share. So they are essentially fairly valued at that level. And we can assume that this is basically what investors are collectively expecting Palantir to achieve right now. So yes, Palantir is a very interesting company with tremendous growth potential ahead of them, but their current valuation does make investing in them pretty difficult because under what I think are reasonable but still slightly optimistic assumptions, they still look overvalued. And if they ever have a quarter in the future where they report, say, 10% revenue growth instead of the 25 to 30% that investors are expecting, then you're going to see a sharp change in investors' perceptions of their growth story, and the stock price is probably going to fall a lot, which is a pretty big risk in my opinion. So thank you so much for watching. I hope you did find this video useful. One last quick thing I want to mention to new viewers of this channel is that I do have a website called tickernomics.com, which is a website that I created. It has data on over 10,000 stocks from the US, Canada, as well as international stocks, including Palantir. So there is financial statement data, there is ratios. We also have a value a stock feature, which allows you to input your assumptions here and actually do a valuation model for a company if you want to do basically what I just showed you earlier in this video. We also have this library of public scripts, which are all unique things that can generate lists of companies for you to start researching if you're looking for ideas or to get some inspiration to invest. So this is all available on the website. Link is in the description if you are interested in checking it out. So thank you so much for listening, and I'll see you guys in the next one.